Hey everyone, Coach Investor back to another video for today. So in today's video, as you can see from the thumbnail, we're going to talk about the situation with regards to Verizon and AT&T, and you can apply it to actually many of the other dividend paying companies that have been underperforming the market for years and years. Of course, these two companies have right now, I think, a pretty similar dividend yield, very close to 8%, but this stock itself, the price of this stock, the performance there for the last decade or more has been abysmal. So let's have a look at what the company is doing right now. So I'm here on Coifin. By the way, I'm gonna have the CEO on the channel, I think on Thursday. So if you have some questions with regards to the platform, let me know down in the comments below. Now I've obviously pulled up here a couple of numbers with regards to AT&T, Verizon, and T-Mobile, because I do know that some people will write in the comments, oh, T-Mobile is a better option because they're growing faster, they are leading in 5G, etc., etc. So okay, I've put all three of them here: free cash flow and long-term debt. Now, with regards to free cash flow, we can clearly see here Verizon in the last 12 months, 15.38, AT&T $13.58 billion that is, and then T-Mobile $3.4 billion. Oh, okay, that's very good. Now, if we're going to look at the long debt in the last 12 months, you can see the big difference here yet again, which in this case favors T-Mobile. Long-term debt there, $69.53 billion in the last 12 months, and then a huge jump if we go and look at Verizon and AT&T, $147 billion for Verizon and $123.4 billion for AT&T. Now, why such a big difference? Well, because of the investment that they're making and have been making for the last couple of years to catch up to T-Mobile, to have better 5G connections, to offer better services to their customers. Now, of course, those things aren't free when we're talking about new infrastructures. Well, there needs to be a lot of investments. Now, since T-Mobile does not pay a dividend, right? AT&T and Verizon do pay dividend, so it's becoming a bit difficult for them to pay their debt, which is not the case for T-Mobile. Now, of course, you can make the case that T-Mobile is not as profitable as the other two. That's because, well, they are reinvesting their dollars in the business. They're also buying back some shares, so that's a form of repaying or rewarding their shareholders. So now you get a bit of all the information that you need to compare the three of them when it comes to free cash flow, because, well, you need free cash flow to pay dividends, you need free cash flow so reinvest in the business, repurchase shares, and pay down your debt. So this is a bit of a major overview, but we can go a bit further. So if we go and look at AT&T first, 5.6 times forward PE. Now, yes, extremely cheap, paying a nice little dividend, but the performance of the stock has been a complete disaster for more than a decade. Now, the estimates for their earnings for fiscal year 2023, when you look at EPS, down 5.46%. In fiscal year 2024, you're going to be up a bit. You're growing at 2.35%. And then right now, fiscal year 2025, apparently basically close to flat to 1% there. When you look at sales, it's a growth of 1 to 2% tops for the next couple of years. Now, when you look at Verizon, we have a forward PE of 7.1 times, so a bit more expensive than AT&T. And here you can see also a bigger negative effect on the forecast for EPS fiscal year 2023, down 9.64% for the year. Then fiscal year 2024 basically flat, and then fiscal year 2025 growing at 2.75%. Now, of course, if you've been following the news around with regards to Verizon, AT&T, and other telecommunication companies out there, you know that yesterday on Monday, news broke out, sending those stocks down 6 to 7% or so. Right now, at the time of making this video, as you can see, Verizon is up 4% or so, AT&T is up as well. Now, what exactly happened? So there was a Wall Street Journal piece that came out. America is wrapped in miles of toxic lead cables. Telecom companies laid them decades ago and thousands were left behind, posing a hidden health hazard today, a Wall Street Journal investigation found. Now, whether you agree or disagree with this, it doesn't really matter right now. The market has already reacted. Yesterday, down a lot. Today, a bit more positive. So you can say this is a hit piece. This is, well, short sellers doing their thing. There is some shady things going on there. Maybe, could be. Or on the flip side, yes, this is an issue that should be tackled and maybe these companies should be held responsible for their actions. And of course, if these things need to be resolved, if these cables need to be removed, it's not going to be free. They need to spend money to remove that. Of course, could be that they're going to work with governments to help and fund these operations. We'll have to wait and see. But I do want to show you a couple of things from that article. So we have already a couple of responses in that article. So the companies of an industry group representing them said they would work together to address any concerns relating to lead-sheeted cables. The US telecommunications industry stands ready to engage constructively on this issue. Then we have from AT&T, the company said the journal's reporting on lead-sheeted cables conflicts not only with what independent experts and long-standing science have stated about the safety of lead-clad telecom cables, but also our own testing. Verizon here taking these concerns regarding lead-sheeted cables very seriously and is testing sites where the journal found contamination. It also added, there are many lead-sheeted cables in our network and elsewhere in the industry that are still used in providing critical voice and data services, including access to 911 and other alarms to customers nationwide. Continue here on some statements. So for decades, we have managed legacy lead-clad cables in compliance with appliance laws and regulations, and we have followed industry-wide best practices to maintain this legacy infrastructure in a way that's safe for all based on established science. And last thing here with regards to AT&T and apparently a litigation that happened back in 2021 because of something that happened in Lake Tahoe. So the test found very low levels of lead in the water, according to a report provided by AT&T to the journal. The lake's water quality is not adversely impacted by the cables, the study said, adding that samples were largely non-detect for lead, including those collected nearest the subject cables. Now, the article goes on and on and on, pros and cons and findings and things like that from the past, etc., etc. It's very, very long. I'm not going to go through all of it, but it is important to note that these cables have been put there, right? Following the law, following regulations. The government allowed all of this to happen in the past, whether it's been used for decades or not. This was approved at one point by government. So if something needs to change here, I don't think all the blame should come and fall on these telecom companies. Oh, and by the way, these aren't the only things that should be maybe looked at or harmful for the environment, etc., etc. Water pipes that have been put into place decades and decades ago could also cause some harm. Maybe there should be an investigation into that as well. I mean, why not at this point? Now, if you're enjoying this video so far, leave it a thumbs up, subscribe. If you have not, we're trying to reach 30,000 subscribers by the end of the year. So thank you very much for the support. And if you would like to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Now, talking about the dividend here, of course, you can see another time a major overview of AT&T and Verizon. In the meantime, I'll talk about the dividend. Both of them are paying a nice dividend to shareholders, have been doing so for a long time. Now, both of these companies are also a perfect example why a high dividend yield should not be at the top of your list, whether or not you will invest in that company or not, because the stock performance speaks volumes. Now, of course, it also depends when you're buying into the company, if you're selling, and all of that, 100%. Because if you have bought yesterday, you would be up already 5%, which is more than what investor could have said for more than a decade. Now, yes, it is true that the dividend helps, right? Because when the stock goes down, then you can basically buy more shares with those dividend payouts, and so building up your position for future bigger dividend payouts. Yes, I agree. But if the company's financials are not improving, meaning if they will reach a point where free cash flow is not high enough for them to keep on paying those high dividends, then these investments become a problem. And so let's have a look what's happened with Verizon and AT&T in the last quarter. Of course, the earnings report are coming up, I think, next week. In this case, Verizon, July 25th. So we're going to cover that. Of course, you can see that in my free Substack newsletter, link down below. So when we look at Verizon, we can see that free cash flow has increased quite nicely year over year from 1 billion to 2.3 billion. Dividend paid same amount, $2.7 billion. Now you can see here the issue, right? Free cash flow, $2.3 billion in 2023, but dividend paid 2.7. So there is already a little gap right here. And as we've seen before, huge amount of debt. So let's wait and see if free cash flow can continue to grow and accelerate. Then yes, dividend payouts shouldn't be a problem. But if there's going to be a gap each and every quarter, it's going to be an issue, and you could maybe expect a pause, if not a cut, in the near future. Now, of course, adding 437,000 broadband net additions will certainly help with future free cash flows, but overall, keep this in mind because it's very, very important for the company to be able to sustain their dividend payouts by having a good performing underlying business. Now, if we go and look at AT&T, we can see here cash from operation from 7.6 billion to 6.7 billion. So there's a decrease there. Capital investment has increased a little bit, and free cash flow has decreased 2.8 to just $1 billion. But they do say here that free cash flow reflects working capital timing, front-end loaded capital investment, and lower DirecTV cash contribution. They are still on track for full-year free cash flow guidance of $16 billion or better. And I think that's more than enough to pay their dividend. And when you look at AT&T 5G and fiber, you look at phone ARPU, that's up just 2%. And then if you look at the fiber ARPU, average revenue per user, that's up 9%. And yes, unfortunately, I do think that these companies will just increase the prices of their services. And no, I don't think any of these huge companies will go out of business anytime soon. And like we've been saying for a long, long time, the last thing that you're going to cancel in an economic down cycle is probably your phone plan, right? Your internet. That's the last thing that people will cancel. And so these are the companies that are perfectly positioned for the future. It's just that they have to manage their business much better than they've been doing in the last couple of years. And so to conclude, I think it's pretty safe to say that these two companies will continue to pay a dividend. Now, if the company's financials do not become better over time, then that dividend will probably become a bit unsustainable for a short period of time until they manage to increase free cash flow and until they manage to reduce their debt, especially in a high interest rate environment. Now, you can say we're reaching the peak interest rates. Then yes, when interest rates will come down, it will certainly help companies like this. But I'm sure that shareholders from those companies don't like to see these huge underperformance throughout the years. Yes, you collect a dividend, you reinvest that dividend into that stock, and so your net dividend payout becomes bigger and bigger and bigger. But still, you need your stock to perform. You need that company to perform, because just betting on a dividend payout, in my opinion, is not the way to go. Yes, I do think that the dividend is safe, but I'd like to see the underlying financials of those two businesses become better over time. So that will be it for this video. Of course, do share your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.